When we talk about the growth of passive versus active investing mandates, we often overlook the growth of hybrid strategies such as smart beta, which are playing an increasingly important part in the investor landscape because they're scalable and easy to manage.
So smart beta are rules-based strategies that aim to capture systematic factors or market inefficiencies. And they can be seen as a hybrid between active and passive. They're passive in terms of that they're transparent, liquid, cost efficient, and they have some characteristics of active strategies that they try to outperform a market cap benchmark. As you can see from this graph, we have an annual survey with the asset owners where we ask questions about smart beta. And in the graph you can see the blue bars are the asset owners who see smart beta as active strategies. And we see there has been an increase to close to 50% both in Europe and North America. And this at the cost of asset owners who see the strategy as passive. And if we look at the growth of asset owners using smart beta strategies, we see that the adoption rate initially was higher in Europe, but currently, both in Europe and North America, as high as 65% of asset owners use smart beta strategies.
Smart beta is a catch-all phrase for a variety of strategies that use specific rules to achieve a number of goals. They're being adopted by a wide variety of investors to fulfill many different goals.
Smart beta strategies can deliver different investment solutions. For example, they can increase diversification, enhance returns, or get rid of unwanted risks. And we can divide the strategies into groups. So we have the so-called factor strategies that aim to capture the risk premium to factors such as value, size, momentum. And this can be done in a single factor solution or in a multi-factor solution. The second group is called the alternative weighted indexes, and they really try to address perceived concentration risk in indexes or the volatility. So, for example, an equally weighted index can help increase the diversification relative to market cap benchmark. So there are different solutions for different problems. When we look at the graph, we see that by far the most popular strategy are multi-factor indexes. And this is because it's quite hard to time single factor indexes. So a multi-factor solution is an easy way to get an improved risk-adjusted return relative to the market cap benchmark over several cycles. And who's using them and why? So the growth of smart beta comes really from two sources. So the first source is a dissatisfaction with active managers, active allocations. And the second one is the belief that a rules-based strategy can outperform a market cap weighted index. When we look at the larger asset owners, they tend to make a strategic allocation to smart beta. And they often use segregated accounts so they can customize a solution to their particular needs. When we look at the smaller pension funds, they tend to go for ETFs, just like the retail sector. And the latest figures at Morningstar suggest that there's 635 ETFs and more than 850 billion assets in just the ETF indexes. And then the final uses of smart beta is a more appropriate benchmark for active managers. So just getting factor exposure is not a skill, but factor timing is a real skill.
Smart beta is also seeing momentum build in the trends that have been impacting the wider investment industry.
Yeah, so we have seen a real uptake in combining smart beta with sustainable investment objectives. So you can target factors and sustainable investment objectives in a single framework, and we call these smart sustainable investing. From the graph, we can see that in Europe, it's really mainstream. 85% of asset owners employ some kind of ESG solution, most often climate, in their indexes. Of course, in Europe, new regulation and other initiative has led to this great adoption rate. So this is a large uptake in combining smart beta with SI in these solutions. And if we look at the next graph, we see the outlook for smart sustainability is very strong. So consistent with last year, nearly half of those who anticipate applying ESG or sustainability parameters expect to increase their allocation next year. 12% says for sure not, and the other 42% is not sure. So this is a main trend in smart beta.
Because smart beta strategies are rules-based, they are devoid of the emotions that can churn active managers around inflection points. One of the biggest challenges will be adapting to new generations of investors. but the low cost and efficient implementation of smart beta suggests that these strategies will continue to play a key role in the institutional investment landscape for years to come.